Good morning. You're watching The Market right here in ET now with me, Aisha Faridi, Nikunj Dalmia, as well as Avan Dabash in the studios. And the cues from D Street first, before Wall Street. And we actually raised some of our gains in the last hour of trade yesterday. Once again, it's been a very, very quiet move for the indexes the last two trading sessions, because even if you were to move, or rather map, how the markets have moved from the session lows to the highs, it's been a very, very narrow band. And yesterday as well, it was pretty much the same picture. The struggle to cruise past and hold above that 19,400 mark continued. Key heavies like HDFC Bank, ICICI Bank, they continue to be drags. And yes, FIIs continue to sell India. Fourth session considering they've been sellers. But yes, the broader market outperformance, that clearly continues. And mid-cap index was once again at an all-time high.
Yeah, it's amazing, right? I mean, you think about it that you are staring at a market where one leg of the driver of this rally from April to July or April to June was global liquidity, and that global liquidity, even though it is no longer that supportive, the markets are holding on. While Nifty may have slipped yesterday from the day's high, the fact that you're holding above key levels, there is no panic in the market, there are no margin calls in the market. Nifty is not exactly cruising along, but mid and small cap stocks, there is a very smart rotation within that space. So I think it is very, very important for us to flag off that in this market, you need to have a differentiated approach where everything is not great, everything is not bad. For the sake of turning bearish, don't turn bearish. And for the sake of remaining bullish, you don't have to remain bullish. In general, the market action, I think, at best is mixed. There is a fatigue factor which has kicked in large cap stocks on expected lines, but there is no panic. There is just no temptation to book profits or even not participate in the small and the mid cap stocks. So it's becoming very selective, and depending on which pocket of the markets you're focusing on. I mean, imagine if you're trying to view the market based on the bank nifty.
Yeah,
it's been a washout. You're making a market if you're making a market view based on Nifty, which is what everybody does, you would say, "Arey market mein kuch nahi ho raha hai."
Flat.
You're making a view based on small and mid cap stocks, you would say, okay, my stock is at an all-time high, the bull market, your stock is an all-time high, catch me if you can. So the narrative is different depending on whom you're asking.
But the only thing is, Nikunj, I mean, not to say that traditionally we've not had these lull periods and very extended lull periods also in the market. But is this calm going to lead to a storm, or is it going to lead to some kind of downside? I mean, upside, downside, will the Nifty take direction? Will the mid caps also stall here?
How do you judge that? You judge that based on what is, let's say, in store and what are the triggers for next 6 months. Let's say from August to year end. You will have earnings season, you will have festival season, you will get indication on where the vegetable prices and the food inflation is headed, and you get a complete clarity on finally whether China is off the block or not. Earnings, I think markets pretty much know that is going to be decent. Consumption patterns we know pretty much are going to be decent. So I think the festival season this time really is crucial in terms of understanding the demand setup. The activity in China, I think, is of paramount importance to understand which way global macros are moving. And then forget tomato, now it's tomato and onion. Both the prices put together, I think they would be deciding. So I think, if you want to ask me, one lead indicator for me is going to be the curry test.
Yeah.
Right? Tomato, onion, ginger.
Pretty much the base for all Indian vegetables.
Yeah, so actually, just like we called it the summer rally of 2023, let's use the word curry test for next couple of days.
Right, you are. Or even the tomato test, whether or not, some of these fast food joints has restarted using tomato ketchup.
Without tomatoes. Are they giving that ketchup free? No, I haven't been to.
Yeah, they are. They are.
Now
they are.
Okay.
But that's inventory,
Well said.
Okay, let's in fact talk a little bit more about that divergence, and we were talking about the kind of underperformance that we've seen in the bank, and if you use that as an indicator in the last 1 month, for instance, while the index itself has been exceedingly flat, the Nifty Bank Index has underperformed. A near 4% drop is what you've seen in the Nifty Bank Index. Heavyweights like HDFC Bank, Kotak Bank, they've been the worst performers in the last 1 month, and Nikunj, the combined weightage here is nearly 40% on the Nifty Bank Index. So that divergence, as you were saying, really continues, especially when it comes to the banks.
No, I mean, IT is up and banks are down. It's always that, I don't know why, but very rarely IT and banks are on the same side of the trade. 2020, The comeback in IT, no comeback in banks. 2021, IT was ruling and banks were underperforming. 2022, the reverse. IT started correcting and banks, they started coming back. 2023, the divergence, I think, is only becoming better. Now, the question you would ask yourself is that why banks are underperforming? And even though banks is one space where there is weightage, where there's ownership, where there is a huge amount of consensus trade, are banks now priced to perfection, which is that this whole template of good credit growth, low NPAs, strong NIMs, is that in the price or fundamentally something is changing? I don't think as of yet fundamentally something is changing in terms of banks, and within banks also you are seeing a complete divergence between what an Kotak has done versus what an IDFC bank has done, how SBI has moved versus how some of the smaller banks like AU Financials have moved. So while the bank nifty may not give you the true rhythm of what is happening in the banking space, I think within the banking space you will see a lot of divergence going forward. I doubt that IT will emerge as the go-to sector, even though it may look like cheap and contra. I think banks is where the leadership is. Right now markets are going through an adjustment process when an overweight trade is getting challenged. But if you have to really watch out for a space where you want to be a buyer, rather than avoiding that space, even though it's a consensus view, I think it's banks. I think large banks and large corporate banks will come back. Mid-tier banks, the re-rating has happened. PSU banks are looking cheap to me. I'm not so sure about NBFCs. I'm not so sure about what will happen to some of the retail-facing franchises within the banking space. But corporate banks right up there. PSU banks, SBI, BOB second, and to some extent, I think some re-rating in some of the mid-tier private banks, I think is still left.
The other aspect in the market is the kind of spike that we are seeing currently in US bond yields. And if you just look at the data points, I mean, yes, it is impacting capital flows to emerging markets like India, but not hugely so. Even if you were to map the sell figure that we are getting on a daily basis, that's not as large.
So Asha, historically what we've seen and observed and what all of us have reported, all three of us, is that when bond yields they go higher, equities they come down. It's very simple. Interest rates are like gravity. And the higher the interest rates go, the more the gravitational pull is going to be. If bond yields have gone back to levels of 4.4, what they were, let's say, before COVID, then why are markets not coming down? I think largely the mystery, there's no mystery. I guess the reason why markets are not panicking is because A, markets think that this inflation is going to be transitory. B, there is a China factor which clearly seems to be indicating that commodities are not going to be any kind of a linear uptick. C, the US economy is not doing all that great that the dollar index is going to sustain any kind of an uptick. So all the factor, what causes inflation? What causes inflation essentially is the movement in commodities and dollar index. We've just discussed that. Second, let's look at the view in terms of where the economy, where the world is headed. It's not looking all that great. So markets expect that inflation is going to be transitory and bond yields will come down. But if you now start moving closer to 5%, then we really have a problem. Then you could ask yourself, is that 5% versus emerging market risk? I think then it will get nullified. You stay here, you kicked around closer to 4%, 4.4, 4.12, markets will say okay. And second, I think what also matters, Aisha, here is that at the beginning of the year, the market view was that US will head into a recession. Soft landing, hard landing, that is what we were debating. Now that template, that scenario is off the table. What are we talking about? Second half, US will have a smart recovery or anemic recovery, but it will have a recovery. So the R of recession has become R of recovery. And that is what I think markets are adjusting to.